So when we are using decision tree, there are some things you need to first know, some key things. You need to know that here we are drawing a diagram. As you draw that diagram, you need to start from a box, and this box is going to be representing your decision alternatives. The box represent decision alternatives. So whenever you see a decision alternative, for you to present that decision alternative, it must start from a box, okay? So a box, your box you're going to be making will represent your decision alternatives. Then number two, a circle. A circle represents states of nature. So it means that for you, it means that every decision alternative must start from a box. And every state of nature must start from a circle. What is state of nature? What is decision alternative? I believe by now you know how to differentiate. Decision alternatives, you have control. These are options available. These are options available to the decision maker. And you have here, you have a control. You have a control as a decision maker. You can decide. You can decide to choose any option available, and it means that you have the control. But with states of nature, these are situations. These are situations beyond the control. These are situations beyond decision makers' control, beyond the control, the decision. That's okay. These are situations beyond the control. It means that you as decision maker, you cannot control states of nature. You cannot. I talked about issues related to customers. You have no control. I talked about issues related to market. You have no control. Issues related to demand. You have no control. Mention them. And because you have no control, what you're going to do is to rely on the probabilities. So it means that for you, as you analyze the question, you are going to find that you're given probabilities. Wherever you're given probability, that is your state of nature. So it means that he is assigned to each state of nature. And probability is not assigned to decision alternative, no. So in an exam, for you to differentiate, you must be in a position to see probability. Where you see probability, know that that is your state of nature. And probabilities can be given also in percentage form. They can say 70%, or they can say 0.7. So you need to look at the question and know what is decision alternative, what is state of nature. Don't cram. If you know these two, then you'll be in a position to actually make your decision tree. And of course, as you draw your decision tree, you need the outcome. You need the outcome. The outcome, of course, if you decide to invest, that is your alternative. Now, what is the final outcome of you investing in maybe in a certain business or in a certain project? What is the final outcome? Of course, the final outcome can be, the final outcome is to get profit, That's what you need. That's the reason why you're investing. So this profit you'll get, you'll find that you start from states of nature, then invest in a certain environment, that is your states of, start with decision alternative, operate in states of nature, then in each state of nature, what can you benefit from? What can you gain? What can you gain? You're going to find that here you need payoffs. You need payoffs, net gain or net loss. You may find that you have operated in a certain environment, and because it is not favorable, you're operating in a loss. So your outcome can be a loss or a gain. But this outcome, we will find that we need to convert this outcome to expected. Because you're dealing with probabilities, so you will need expected profit, you will need expected loss as your final outcome. But how can we do this practically? So let's use some questions. Last time we discussed these questions. We discussed question 1 and question 2. We are going to look at question 3 and question 4, plus any other. So let's start with question 3. They are telling us we advise the director on whether to produce the concentrate during the year ending 30th June 2023. Okay, and they are telling us that we use decision tree analysis. You advise the director on whether to produce the concentrate during the year ending 30th June 2023. So how can you use decision tree analysis to advise your director? Okay. What are they telling us? They are telling us that Ndio Poultry Farm, that is NPF, located in Nimitiana district, deals majorly in egg production. NPF imports concentrate from Kenya, which is one of the major feeds input. Okay. They are telling us that there is a 60% chance of good economic environment during, okay, there is a 60% chance of good economic environment occurring during the year, with a 70 chance of making a profit of shillings 100 million when the concentrate is produced during good times. Otherwise, a profit of shillings 20 million can be made. Now, colleagues, when you're analyzing your question, it's not just about reading. You need to know what do you want, of course. Remember, you're preparing decision tree. You're preparing a decision tree. So it's good for you to first observe or to first identify what are your decision alternatives. After knowing your decision alternatives, then you need to know what are your states of nature. It's very key. It's very, very key. Otherwise, you'll just keep on reading, which doesn't make sense. So as we read, of course, I'm going to read for the first time. Then the second time I'm reading the case study, I must be answering. Okay. Here they are telling you it's 60% chance of finding that the environment is good. You're operating in a good economic environment. The percentage is 60. So don't just read. I told you whenever you say percentage, know that there is that is state of nature. This is chance. This is probability. 60% chance. That is probability. So it means that as I read, I have highlighted this. I know that this is my first state of nature. And if they have given me 60, then what is the remaining percentage? Of course, the remaining percentage is what? Is 40. Isn't it, colleagues? So, and that 40% is representing what? If they are telling you 60%, it's a chance of good economic environment occurring, then it means that 40% is the chance of bad economic environment. They will not tell you that. It's you to know. It's you to know that if they have not given me the other percentage, I should know that the other percentage is for bad economic environment. Okay? Okay, so let's move on. So here you have identified that you have good economic environment. And if you operate in a good economic environment, then there is also this percentage. It's a probability of making this profit. Okay? When the concentrate is produced during good times. So it means that this 70% is also related to when you're operating in a good economic environment, in a good times. Of course, there is also bad time. They are telling you in bad times where there is otherwise you can make a profit of 20 million. That is when the concentrate is produced during bad times. So you should know that. Okay, the chance of making a profit of that. Let me just write something. Yeah, this is question 3. When a concentrate is produced, I'm trying to summarize. When a concentrate is produced, don't rush to write. Don't rush. Don't rush. So when the concentrate is produced, of course, you're going to operate in a certain environment, okay? This environment you're going to operate in is that the environment can be good or bad. So I'm going to put here good economic environment. And the percentage they have given, which percentage? They are telling us that there is 60% chance of good economic environment occurring during the year. Okay. So that is 60. Here you can write 0.6. What does this one mean? It means that when the concentrate is produced, of course you may find that you have produced your concentrate in a bad economic environment. And that chance is what? Bad economic environment. That chance is what?
Is 0.4.
0.4. Okay, let's proceed. They are also telling us that there is 70% chance of making a profit when the concentrate is produced during good economic times. Already I have my good economic times here. This is your good economic environment. You have produced your concentrate in a good economic environment. What is the chance of making profit? They have given you the chance of making profit. They have given you a certain percentage. That percentage is what? The percentage of making the profit. They are telling you there is 70% chance of making a profit of shillings 100 million when the concentrate is produced in a good times. That is 70%. So here you assume here you have 0.7. That is 70% chance. Of course, this is good times. You will make a profit of how much? The outcome, you will make a profit of how much?
100 million.
Okay. They are telling us that there is a 70% chance of making a profit of 100 million when the concentrate is produced during good times. Otherwise, a profit of 20 million can be made. When they say otherwise, it means that there is another chance, the remaining chance of 30%. So here, if you're operating in a good economic environment, there is also a chance, that is 0.3 chance of finding that you're making, let me put this, you're making a profit of how much? You have a chance, you can make 70%. There is a chance of, there is 70% chance of you making 100 million, and also there is 30% chance of you making a profit of 20 million. So that's what you're going to indicate here, 20 million. That is 30% chance of you making a profit of 20 million. I'm just trying to summarize. I'm just trying to summarize. Then they are telling us that the chance of making a profit of shillings 20 million is 80% when the concentrate is produced during a bad economic environment. Remember, you have bad economic environment somewhere, and they are telling you there is 80% chance of you making a profit of 20 million. Otherwise, you can make a loss of 40 million. What does this one mean? It means that here you're going to come back here, where you have bad economic environment. Where you have bad economic environment. You have also two chances. The first chance is what? Which percentage is given? The percentage given is what? 80%.
80%.
So here I'm going to say, when you're operating, when the chance is 80, what profit can you make? 0.8. What profit are you going to make?
20.
Let me see. The chance of making profit is the chance of making a profit of 20 million is 80. So it means that at 80% chance you can make a profit of 20 when you're operating in a bad economic environment. But otherwise you can make a loss. Otherwise you can make a loss. At what percent? At what chance? That is 0.2. The remaining percentage, here you have 80. It means that the remaining percentage is 0.2. And they are telling you that otherwise a loss of what? Of 40 million can be made. So this is not profit, it's a loss. So where you have the final outcome, you're going to put a negative what? negative 40 because it's loss. So let's go to the next paragraph. They are telling us that the probability of making a profit of shillings 120 million is 0.6 when the concentrate is imported. This is very key. This second paragraph, you are looking at a situation where the concentrate is produced. But here you're looking at a situation where the concentrate is imported. Let's focus on this when the concentrate is imported. What is going to happen? They are telling us that when concentrate is imported, there is 60% chance of you making a profit of 120 million. They have given you the percentage 0.6. That is during good economic environment. So it's the same thing, just that figures are changing here. So here the percentage is what? When the concentrate is imported, good economic environment is 0. Already you have that. And the bad economic environment is 0.4. This one will not change. What is going to change? What is going to change is at a point you're making a profit. At a point you're making a profit, the chance is 0.6 or 60% for you to make a profit of 120. You get? So what you're going to do is to change here. Remember, it's at this point where we are making our final outcome. So here the percentage is what? For the when the concentrate is imported. When the concentrate is imported and you're operating in a good economic environment, they are telling us that it's 0.6. The chance is 0.6 for you to make a profit of how much? The chance is 0.6 here. The chance is 0.6 for you to make a profit of 120 million. Okay? So the outcome is 120 million. Then next, it means that the remaining percentage here is 0. What? It's 0.4. Good economic environment, you also have a chance of 0.4 of making what profit? They are telling us otherwise a profit of shilling 30 million can be made. That is during a good economic environment. Okay. So here at 0.4 chance, we are making a profit of 30 million. We are still handling good economic environment. When the chance is 0.6, you can make a profit of 120 million. When the chance is 0.4, in a good economic environment, you can make a profit of 30 million. Okay. Next, they are telling us that the probability of making a profit of shillings 40 million, this is the probability of making profit of shillings 40 million is 0.3 when the concentrate is imported during bad economic environment. Okay. So here you have bad economic environment. You have imported during bad economic environment. There is 0.3 chance. There is 0.3 chance of you making a profit of how much?
40 million.
40 million. Okay. This is 40 million. Then what is the remaining percentage? Or the
0.7.
probability? 0.7. And here you are making a profit or a loss?
A loss.
When you import in part, they are telling us that otherwise a loss of 40 million can be made. Otherwise, it means that at a 0.7 chance you can make a loss of 40. Okay. It is still 40. The loss is 40. Hmm?
Yes, it is 40 million.
Okay, okay. So that's all. That is our summary. That is our summary. So it's a matter of now putting a box and a circle, and that will be all. Yes, please.
Can I ask something?
Yes, feel free.
It looks funny, but I just want to know. Is it possible that they can bring? Is it possible that they can bring a question with a different percentage for good economic environment? For example, when you're importing.
No, it cannot. Remember, here you are in a business. That's what we said. You are in a business, and you're operating in a certain environment where you have no control. You get?
Okay.
The environment you're operating in, you have no control. Whether you produce, whether you import, you have no control. And because you have no control, then we rely on the probabilities. The probability of you operating in let's say, a good environment, whether you produce or import, it should be the same. It doesn't mean that when you import, the environment will change. Martin, is it okay?
Yeah.
Environment cannot change. It will remain. Either you're importing when maybe it's a good time. And when it's a good time, what is the percentage? So just what can change? What can change are these probabilities of you making profit or losses. Because now you look at the situation of you importing, you have incurred some costs. Remember, by the time we look at the profit, you have considered the purchase costs, what you're going to sell, revenue minus total costs. So because of importing and producing, you may find that you have added advantage. Maybe you are purchasing raw materials at a lower cost. You importing, you find that you have incurred a lot of costs. Import duties, maybe you have also incurred the transport costs from maybe China to Uganda. You find that obviously you're going to make you are going not to make a lot of profit. It all depends. It all depends. But what can change are these probabilities. These ones can change. But here, the environment cannot change. It's either good or bad, but it cannot change. Whether you import, whether you produce, you are going to operate in that what? In that environment. But is it okay?
It's okay. It's okay now.
Okay. So let's see. Let me make. Remember, we said every alternative must start from what? Must start from a box. So I'm going to make my box here. So here I have presented my alternatives. when the concentrate is produced and when the concentrate is imported. Because those are alternatives. I can produce or I can import. These are my alternatives. So after doing that, what you're going to do, of course, these are states of nature, colleagues. These are states of nature. Remember, each state of nature must start from what? We have said that each state of nature must start from a circle. So for you to do this, I expect each state of nature to start from a circle. So I'm going to make a circle. So this one, 0.6 is starting from a circle. Also 0.4 is starting from a circle. Also these probabilities, these ones must start from a circle. These ones must start from a circle. So where you have good economic environment, before putting 0.7 and 0.3, here you are going to put a circle, and also you put here a circle. So this is what I'm trying to mean. That for you to present this 0.7, it must start from a circle because it's state of nature. Also this 0.6, it must start from a circle because it's state of nature. Okay? When someone is marking you, he must be in a position to see this. He must be in a position to see this. So once you're done with that, then you can present your outcome. You can present your outcome. At a 0.7, you're making a profit of this. At a 0.3, you're making a profit of this. When the environment is good, that is when it's a good time. So we are done with this. So you can make, I think from this you can finish. You can finish. Even here you are going to do the same. In your book, here you will put joint probability. And in an exam, you can do this. Change your booklet or your answer sheet into a horizontal form. Don't use vertical, otherwise it will not fit. You can present in a horizontal form. It's allowed even in an exam. Then here you put expected profit or loss. That's what you need. You need the first outcome, profit. Then you will need joint probability. Why joint probability? Because you have different probabilities. You have this is 0.6. You also have 0. Before making this profit, you started from 0.6, then to 0.7. So you will need joint probability of 0.6 times the 0.7. That's what we are meaning. Then here, at this point, what will be your joint probability? It is 0.6. This one, then times 0.3. Times 0.3. You do the same for others. Like here, it's 0.4. This is 0.4. Then times 0.8. You do the same for all. This is 0.4 times 0.2. Then to get expected profit, remember the word expected, it means that you're putting probabilities into consideration. So you get your profit, 100, then you multiply by the joint probability. You get your profit times the joint probability. So colleagues, you can finish. You can just try to do all this and you complete. You complete everything. Put some speed. Some speed. Here joint probability is what? Okay, let me first make. So as I make, also be finalizing. To get your expected profit, or else you get your profit times now. If you want to use your decision tree to get expected monetary value for each alternative, remember this is your alternative. So the question is, what is expected monetary value for first alternative, and what is expected monetary value for the second alternative? To know that, you just see this branch. Are you seeing this branch? This branch. You add everything that is on this branch. Here, where you have expected profit, you get this plus this plus this plus this. You'll be in a position to get. Even sometimes in an exam, it's allowed to do also that you can add, like, you add this and put it here. It's also allowed. This is just expected. I can call this expected. I can call this one expected monetary value. Also for another alternative, that is when concentrate is imported, you can also add and add this. Also, this is expected monetary value. So if you were to advise, this company on whether to choose option 1 and option 2, which one is better? Which one is better, to produce or to import? Which one is better? Which one is better?
Produce.
You look at your expected monetary value, the one with higher figure. When you import, this is the overall amount you can get. Rather, when you produce, this is the overall amount you can get, the overall profit. When you import, this is the overall profit you can make. So here you would advise this company to import rather to produce, since it gives what? The highest expected monetary value of 48.8 compared to importing, which results into 44 million. So that's all. However, we go back at our required part. What do they need? You advise the director on whether to produce the concept. Oh, okay. So the question is, can they go ahead and produce? We have confirmed. You advise the director to produce the concentrate during the year, because producing concentrate results into a higher expected monetary value compared to importing. This is what the examiner expected from you. To compare these two values, compare this and this, then advise accordingly. So you're going to say that here, the director of shillings, you write the figure, it was 48.4 million compared to when the concentrate, is imported. Compared to expected profit of shillings 44 million when the concentrate is imported. So that's all. That's all. So colleagues, any question? Someone in the chat is saying, when interpreting this question, it is always hard. I understand, but it's a matter of practicing a lot of questions. It's a matter of practicing a lot of questions and also not cramming, because all you need is to know, am I dealing with decision alternative? Am I dealing with state of nature? Once you know that, it becomes very easy. It becomes very easy. So I want also to use this question to get expected value of perfect information. We want to get expected value of perfect information. Who can recall the formula? How do we get expected value of perfect information?
It is expected value with perfect information minus expected value.
This is expected value with perfect information minus the maximum or highest expected monetary value. So we have highest expected monetary value, which is equal to how much? We have highest expected monetary value of how much? What was our highest? 48. Rodriguez, are you following?
Yes, we are following.
Okay. Then how do we get expected? How do we get expected value with perfect information? For each state of nature, choose the highest expected value. For each state of nature, choose the highest expected value. So we start. When the concentrate is good, basing on these values here, basing on these values, which one is higher? looking at good, when the concentrate is good, you have this, you have this, you have this. See where you have good, sorry, when the environment is good, this one, you have this, you have this, okay? Then you go to concentrate. Also see, you have this, you have, yeah, you have this and this. So for each state of nature, you choose the highest value for each state of nature. Just so that this is not a payoff table. This is not a payoff table. This is decision tree, but we are using the same concept. If at all we are making the payoff table, you find that you have these ones in a column form, these ones in a column form. This is for the situation of concentrate, when the concentrate is produced. This is the situation where when the concentrate is imported. And we are saying for each state of nature, choose the highest value. So what is the highest value? Here you have 42, here you have 3.6, here you have 4.3, here you have 7.2. Which one is the highest?
43.
42?
Oh. 43.2.
Oh. So you first choose 43.2. Good time. Good time. Here you have seen that it is 43. 43.2. Then next. Bad economic environment, bad time. Also observe. Here you have 6.4, you have negative 2.2, negative 3.2. Then down, you have 4.8, then negative 11.2. Which one is higher?
6.4.
6.4, let me see. Yeah, 6.4. 6.4. But colleagues, are you picking what I'm doing? Nandi, don't keep quiet. Don't keep quiet. We are trying to get expected value with perfect information. How do you get that? You base on states of nature. And for each state of nature, you choose the highest expected value. This is your state of nature, good time. Remember, you have good economic environment here. You also have good economic environment here. So analyze all the values, choose the highest. Analyze all the values and choose the highest. Wherever you have good economic environment. Okay, so if you add, what do you get? If you add this plus this, that will be your expected. That will be your expected value with perfect information. And you substitute, therefore the expected value of perfect information.
Abel, as we have known.
Pardon?
I thought we were supposed to subtract highest minus the lowest state of nature.
No, we don't subtract. When we are looking for expected value, we subtract here. When we are getting expected value of perfect information, you get expected value with perfect information minus following this formula.
Okay.
But here you simply add, because you're looking for the overall expected value is perfect information. Looking at each state of nature, you get for the first state of nature, add. Then if you have 3 states of nature, you add. You may find that you have moderate. This is 49.4 minus C. Our highest expected monetary value is 48.4. So what will be your expected value of perfect information? Subtract.
Abel, is that 6.2 or 6.4?
Abel,
that
48.4, it is 48.8.
48.8. Let me go back and I see. Oh, yeah. Thank you. Here we put 8. So we get expected value.
6.2 is 6.4.
This is what? 6.4.
6.4.
Let me go back here. We have 6.4. Oh, yeah. It's the one that is higher. 6.4. So we get this plus this. Then we come back here. And this is 0.8. What do you get? This is what I have. And remember, it's in a million. If there is a question, please feel free to ask. Have you all understood how we get this from decision tree? Last time I talked about how we get these values from the payoff table. But now I'm explaining how we get these values from the decision tree. Okay, so colleagues, that's all for this question. Just I added this in, examiners are funny. They can ask this. From your decision tree.
Do you put 0.8 million or you round off to 1?
You can maintain this. Or you say approximately to 1 million. But you first write this. And unless if at all this side you are rounding off, because here we are keeping decimal points. So if you are rounding off, then here also you'll be having a whole number. But ideally, this is 800,000. It is shillings 800,000. 0.8 million is the same as 800,000.
If we round
Okay.
off, we get 1 million.
Okay.